Y'all ready for this? Let's go.
Welcome back to the Ben James Smith podcast. Over the last few episodes, we've talked about the UK rental market, the movement of institutional capital, and why controlling capital changes behaviour in property investment. Today, I want to focus on something that sits underneath all of that. Why most property developers fail when they try to scale. Because interestingly, many developers don't fail at the start. They fail when things are going well. More deals, more capital, more activity, and yet that's often the point where risk begins to build, quietly and often invisibly. So today we're going to unpack why that happens and how structured investment fund platforms avoid it. Part 1, the illusion of growth. In property, growth is usually measured in activity. More sites acquired, more units built, larger developments undertaken. From the outside, that looks like success, but growth in activity is not the same as growth in stability, because every new project introduces new variables, new timelines, new dependencies, and unless the system managing those variables evolves, complexity grows faster than control. That's where problems begin. Part 2, the 3 breaking points. Most developers encounter the same 3 constraints as they scale. Breaking point 1, capital dependency. Every new deal requires new funding, so the developer is constantly raising equity, negotiating debt, aligning timelines. This slows decision making, and more importantly, it introduces uncertainty, because capital is not always available when opportunity appears. Breaking point 2, operational bottlenecks. As volume increases, internal teams become stretched. More projects require more oversight. More oversight requires more people. More people introduces communication breakdown, inconsistent decision making, increased cost, and suddenly the business becomes harder to manage, not easier. Breaking point 3, timing risk. This is the most dangerous one. Developers become exposed to timing they cannot control. Refinance windows, sales markets, lender behaviour. If one of those shifts, the entire project can be affected, even if the underlying asset is strong. And that's why many profitable developments still fail. Part 3, why this happens. All 3 of these problems come from the same place. The business is built around transactions. Each project is sourced, funded, delivered, exited individually. There is no central system, just a sequence of events, and sequences do not scale well because each repetition introduces new risk. Part 4, the fund platform alternative. Now let's look at how fund platforms approach the same problem. Instead of building around transactions, they build around systems. Instead of asking, what is the next deal? They ask, how does the system deploy capital repeatedly? This changes everything. Capital is structured at the fund platform level. Decision-making follows defined criteria. Execution is distributed across specialists. The fund platform becomes a coordinator of activity, not the source of all activity. Part 5, removing the bottlenecks. Platforms avoid the 3 breaking points we discussed earlier. Capital dependency removed. Capital is already in place, so decisions are based on merit, not availability. Operational bottlenecks reduced. Execution is externalized. Contractors build. Project managers manage. Surveyors monitor. The fund platform governs, so internal complexity does not scale with activity. Timing risk controlled. Because capital is controlled, timelines become flexible. The platform is not forced to act due to external pressure. It can wait, adjust, or adapt, and that flexibility preserves value. Part 6, why this matters to investors. From an investor's perspective, the difference is significant. A developer offers exposure to projects. A fund platform offers exposure to a system. Projects can perform well or poorly, but systems determine how consistently capital is deployed and protected. And consistency is what allows capital to scale. So when we look at property development, it's important to understand that failure is rarely about capability. It's about structure and capital availability, not relying upon third-party lenders. Developers don't fail because they can't find opportunities. They fail because their model cannot support growth. Fund platforms succeed because they are designed for it. Thanks for listening, and remember, growth doesn't break businesses. Weak structures relying on others do. I'll see you in the next episode.